Welcome to the TrustleBridge Capital monthly video series entitled Asking for a Friend. I'm your host, Eric Jefferson, and for this month, we're going to focus on forecasting the S&P 500 returns for calendar year 2024. Going to go through a few different scenarios that we use when we take a fundamental approach to try and attempt to forecast where that index may trade through the balance of the 12 months ahead. Now, before we get started, have a few quick words from our legal team. With that, we can go ahead and begin. So to begin, I want to start by introducing the two key metrics used in fundamental analysis. On the left-hand side of the page, we have the price to earnings ratio. This is determined by dividing a stock's price by its earnings per share. In essence, this reflects the multiple, or how many times over investors are willing to pay for the underlying earnings that a company generates. All else being equal, a high PE suggests a stock could possibly be overvalued. We all know legendary investor Warren Buffett. He is famously known for identifying good companies with attractive valuations. Price to earnings ratio, arguably the most widely accepted measure of a company's value. Then on the right-hand side of the page, we have earnings per share. This is simply determined by dividing company's profit or the earnings that it generates by the number of outstanding shares of its stock. All else being equal, higher earnings per share generally indicates a greater value. Now, before we can forecast different scenarios, let's take a look at where we are trading today, roughly halfway through the month of December. Currently have the S&P trading just around 4,600. That is the price level of the underlying index. Earnings per share estimated to finish this year at $221. So using some basic arithmetic there, that will get us to a price to earnings ratio just shy of 21 times. Historically speaking, that is fairly average. Obviously, PE ratios can increase during risk-on periods as well. You would expect them to contract during more sluggish, volatile environments. Now, as we think about the different scenarios for the calendar year ahead, let's first assume those bulls or those risk-on investors are ultimately proven to be correct. Would not be unsurprising to see PE ratios continue to drift marginally higher. Here we've illustrated a move from 21 times up to 23. Again, that is still within the range of average for a risk-on bull market. As well, we could anticipate that earnings would grow or increase by about 10%. That would get us from a figure of 221 currently up to $243 per share for the S&P 500. Some basic arithmetic then gets us to a price level just shy of 55.90, representing roughly a 22% gain from where we are today. Now, going the other direction, let's say that our economy not able to continue to grow and avoid the impacts of significant rate hikes over the last 18 months. In that scenario, likely expect that PE ratios contract on average by about 25%. That would get us to a multiple of 18 times. Earnings per share typically contracts about 15% in the average recession. So again, using some arithmetic, that would take us from 221 down to 164. The math there get us to a price level of 2,900 for the S&P. In that scenario, representing nearly a 40% decline from current levels. Now, the good news is if a recession does in fact play out, this would be the most widely anticipated recession. The good news there is many companies have already taken the steps to prepare for this. So if in fact a recession occurred, I think it's very likely that it would be on the milder end. So let's say that the PE and earnings per share contractions were half of what the average recession entailed. That would get us to a 19 times 205 earnings, a figure of 4,000 for the S&P, just shy of 13% from where we are trading today. Now, the easy part in fundamental analysis is going through, looking historically, what are those changes to PEs and earnings in different scenarios, using that to then forecast price levels. The more challenging component is understanding what is the probability of those different scenarios taking place. At the bottom of your screen here, you can see our best guess or estimate of what those future scenarios would look like. That is based upon a lot of research looking at the data, both for markets, economies, looking at trends. So, what do those leading indicators suggest, as well as the input from some of the best and brightest minds on Wall Street. The end of the day, though, that is nothing more than an estimate. Absent a crystal ball, nobody knows exactly how markets will play out. And that's why when we look at a weighted average, so taking the probability of each of those scenarios times the respective gains that they would in theory offer, as we result at a fairly muted outlook for the stock market ahead. You can see that's why we have maintained our cautiously optimistic allocation, still participating in the market in the event this is a new bull market, but also being very mindful of those downside risks. At the end of the day, want to ultimately be able to allow clients to grow portfolios and do so by not losing, particularly in those very volatile drawdown periods. Now, there are certainly periods of time where markets will disconnect from their fundamentals. There's no one strategy that works best all of the time. Over longer periods of time, though, you do see markets generally trade within the framework of PEs and earnings ratios. That's what gives us the confidence to be able to forecast these levels. So with that, I hope you enjoyed this month's installment. As always, please don't ever hesitate to reach out if you'd like to discuss in more detail or have topics you'd want to see featured in additional sessions. Thanks again for tuning in, and have a great holiday if we don't connect before.